Mondial, 4 questions with 2 charts, our weekly segment where we try and make sense of the markets for our clients. In our 3rd week now, Sean is now speaking with Thomas McDonald at Russell Multi-Asset Funds. Thomas has been there since 2011, is the investment portfolio manager there, and looks after approximately £1.5 billion worth of UK, Japanese and Middle Eastern pooled and segregated accounts. Thomas is also the backup portfolio manager for the UK and European multi-asset accounts, including their flagship multi-asset growth account. So let's see what he has to say.
Question 1. Since that torrid day, 20th of February, when markets slumped downwards, since then markets have gone up and down and all over the place. It's now the 3rd week of June 2020. How do you see market conditions today?
Over the last couple of months, it feels as though we've been through the full cycle of investor emotions. From panic in March, disbelief in April, acceptance in May, and outright euphoria in June. And we've seen recently a general change in stock market leadership to accompany this. In May, for the first time in years, investors started to migrate towards value stocks, buying oil companies, airlines, and European banks. This rotation has been taken to the extreme in June with a speculative frenzy, where investors have not just been buying up cheap airlines, but buying companies that are literally bankrupt or are proven frauds. I've created my own index to monitor this phenomenon. I call it the bankruptcy basket, and it contains these bankrupt companies. From the 1st of June through to the 17th of June, this basket, equally weighted, is up 74%. Investors, seemingly, are willing to buy securities that will most likely end up with 0 residual equity value, playing the ultimate game of hot potato. Personally, I don't think that this chasing of bankrupt names will last. I think that eventually investors will come to the realization that these companies are indeed bankrupt. But many commentators are looking at this sign of euphoria as an excuse not to invest in the stock market, to keep away. I don't see it that way personally. I view it as more as awakening the sleeping retail giant, a sign of the potential latent wall of money that is out there. Retail investors have largely been absent from the market since 2000 and 2008, largely a function of the psychological scarring that was endured over that period. But this recent episode of euphoria shows that given the right narrative or theme, there is potentially a wall of money out there in the retail space, which can be very bullish if it manages to coax investors back into the market.
With Trump trailing badly in the polls, how do you see a Biden presidency evolving?
For the election itself, we already have a pretty good idea as to what a second-term Trump presidency will likely entail. But the question is, what about a Biden presidency? Now, it obviously all depends on constraints here. If Republicans control the Senate, then Biden won't be able to do all that much. But if the Democrats do take control of the Senate, I then think that an unconstrained President Biden would likely confront the issue of wealth inequality head on. If you look at the gap between the richest decile and the bottom decile of America, it has never been wider. And I do think that this has been a significant contributing factor to some of the unrest that we've been seeing. Obviously, the primary factor was racial injustice, but this is nevertheless a big contributing factor because there is a whole subset of society that feels left behind. So I think one of the very likely outcomes of a Biden victory, again assuming a Democrat-controlled Senate, will be to seek to address this gaping wealth inequality via amendments to tax policy. And this just feels like low-hanging fruit. Biden has already spoken about reversing the Trump tax cuts, for example. But I think one of the additional areas of focus will be to go after US companies that have been effectively getting away with murder, contributing very little in the way of taxes in recent years. So the implications of this are that the accommodative tax environment that has favored US equities over the rest of the world is likely to cease to become such an advantage. The other thing to look at are those sectors that have benefited the most from a low tax regime, like the information technology sector. So here I'm talking about companies like Microsoft and Apple, but also those new media companies like Twitter, Facebook, and Google. So these are just some of the things to think about in the event of a Biden presidency as far as it pertains to portfolio-related issues.
I was listening to an economist the other day saying that typically we expect the S&P and investments to make about 7% per annum. In the current environment, where do you see investors need to go to in order to get that sort of return?
We looked at what kind of asset class mix would be required to achieve a return objective of 7.5% over the last few decades. In the 1990s, bond yields were very high. Investors could easily achieve a return objective of 7.5% with 100% of their portfolio invested in bonds and predominantly government bonds. In 2005, government bond yields were starting to yield less than they were in 1990. So you started to need to open up the rest of the portfolio and introduce riskier asset classes. And when you start to introduce riskier asset classes, like equity, for example, the standard deviation, which is a measure of volatility of the portfolio, that starts to move higher. For 2020, this year, to achieve a return of 7.5%, you need to really ramp up the risk. You need to allocate almost the entire portfolio to equity, and therefore the risk increases as a function of the pursuit of that return target or that return objective. And the primary reason for that is because government bond yields are yielding practically nothing right now. The net result of this portfolio is that risk, as measured by volatility, is almost double that of what we saw in 2005. The point here is that returns of 7% are still possible, 7% and above. But those returns will likely be accompanied by a significant increase in risk, which means that vulnerability increases during periods, just like we saw in March of this year. In our view, the best approach is a well-diversified multi-asset portfolio that can deliver returns analogous to that of equity markets, but will also be resilient during volatile periods.
Much of what we do at Mondial is about retirement planning. One of the key objectives of retirement planning is to sustain the purchasing power of your investment. That means that inflation is a big enemy. How do you see the future trend of inflation?
Let's start with what we know. Interest rates, which are the traditional tool to control inflation, will be likely kept at zero for the foreseeable future. Last Wednesday, Jerome Powell, chairman of the US Federal Reserve, confirmed that with a quote, "We're not thinking about raising interest rates. We're not even thinking about raising interest rates." And that's probably the most dovish sentiment to ever come out of the mouth of a central banker. Of course, low interest rates in and of themselves are not the catalyst for inflation. And you just need to look at the Japanese scenario where they've had zero interest rates for the last 2 decades. But by not hiking interest rates, keeping them pegged at zero, this will ensure that any embers of potential inflation will not be prematurely smoldered. In the near term, however, the current economic environment is very disinflationary, meaning there are downside forces affecting inflation. We've just been through a recession, which tends to make consumers quite conservative. They focus on saving and paying down debt, repairing their balance sheet. And also there's an elevated level of unemployment in the United States, currently at 13%, and the UK is likely not that far behind, indicating a lot of spare capacity in the economy. But over the longer term, there are inflationary tailwinds. There's the stated desire from the US administration to start onshoring manufacturing of key critical industries, whether that's across defense, technology, or pharmaceuticals. So just as globalization was disinflationary as developed countries took advantage of cheap labor in emerging market nations, the reverse trend should be inflationary. The other possible catalyst is the potential for higher corporate taxes under a Biden presidency, which I mentioned before. To the extent that higher taxes are passed on by companies, this will likely be inflationary. These are just a couple of potential catalysts. We don't know what will ultimately drive inflation, but we do know that conditions right now are very accommodative to future potential inflation.
And I believe you were one of the early architects of this type of slide, but I used it a hell of a lot when I'm talking to clients because it explains the increasing nature of the risk. Can you go back into this slide and give us more detail?
We spoke about this chart earlier, but I do think it is really important and worth a bit more discussion. Right now, with interest rates in the developed world collectively at zero and bond yields not that far off, this environment of financial repression really forces investors to take more and more risk to achieve return objectives. Of course, investors have the option to just completely opt out of the system altogether and hold cash. But this is not going to put you in a good position to meet your return goals. Realistically, with equities as the only viable asset class to achieve returns commensurate with lifestyle goals, this creates a huge potential demand for equities and therefore acts as a bullish tailwind simply because of the acronym TINA. There is no alternative.
Perils of timing the market. Tom, as you know, instinctively, a lot of new and inexperienced investors believe that if they could get out of a falling market and get back in a rising market, that would be a very sensible thing to do and clearly make more money than going up and down. Can you help us explain the perils of trying to time the market?
During these periods of uncertainty and volatility, it has never been more crucial to recognize the importance of staying the course with your investment strategy. There will be episodic periods of volatility. This is inevitable, but ultimately markets bounce back, recoup their losses, and over the long term, resume their upward trajectory. We saw that in 2008 and 2009, and we saw that recently this year in March, albeit very sped up. And there are plenty of other historical examples to point to. On screen, this example shows 2008-2009, and I just wanted to show the impact of cashing out at the trough during the biggest moment of panic and crisis. As you can see, the market went on to rebound aggressively, and those who did put everything in cash had to wait on the sidelines and painfully observe a multi-year bull market, despite the economy being in a still very fragile state. There was still, even back then, a big disconnect between the economy and financial markets. The same applies again today, in 2020. Already, those who moved to cash in March have missed out on an enormous rally. The point I want to get across is that, first of all, it is rare to be able to time the top perfectly and to get out just in time. But it is virtually impossible to be able to both get out and avoid the crash, and then get back in at the lows before the rally kicks off in earnest. There were definitely investors that I speak to who got spooked by COVID in February and cashed out before March. They were patting themselves on the back. Unfortunately, they retained that defensive mindset. They were anchored to it, and subsequently, they missed out on the ensuing 30% rebound over April, May, and June that we've seen. At Russell Investments, we don't rely on human emotion or instinct. We are not trying to heroically call the tops and bottoms in markets. We don't think anyone can do that with regularity and with success. Instead, we follow a process that is designed to remove this emotional element and allow us to lean into or out of markets to ultimately avoid the worst of the crashes. We're not flipping entirely in and out of cash, but instead we're deliberately tilting the portfolio to cushion during the most volatile periods and starting to add back equity exposure when the market starts to rebound.